Holy crap. Today just got insane. From the panic selling to the recession. What's going on? I'm here to break all of this down and put this into context for you. We will also go over what Fundstrat and Tom Lee is saying about today's drop in our markets. Taking a look at the Russell, your IWM, I was expecting a 5 to 6% fall by Friday, but if you want to include the Powell rally top, you've actually already fallen about 9%. If you exclude that, you've fallen about 7%. I was a little conservative, turns out, on what kind of selling we were going to see post Powell. I mean, after all, who could have forecasted the data that we got today? No economist was correct on this. Non-farm payrolls were revised lower from last month's 206,000 down to 179,000, and your non-farm payrolls for the month of July come in at 114,000. We were expecting 175,000. So this was a very low number. This is a bad number, way lower than expected, but it's not the worst number we have had in the past year. Back in April of this year, you were at 108,000 jobs. The non-farm payrolls is not what is moving the markets today. It's the unemployment rate. So the unemployment rate was expected to stay at 4.1%. It didn't go up to 4.2%. It went up to 4.3%. So you are now starting to see a rapid rise in unemployment. This is, I mean, about as foolproof recession kind of indicator as you can get. David Rosenberg writes on X, the SOM rule triggered the recession call today. The chart here shows that the 80 basis point jump in the jobless rate over the past year is a 100% ironclad indicator that the downturn has either arrived or is about to. The Fed is as behind the economic curve now as it was behind the inflation curve back in 2021 and 2022. Most of this tightening phase and cyclical bear market in bonds is set to unwind in dramatic fashion. So with the SOM rule, it's really just showing you velocity in unemployment. So velocity is starting to pick up in unemployment, and unemployment velocity is much the same as inflation velocity. Once it starts, it is hard to get that cat back in the bag. I mean, you're running around the neighborhood trying to get that cat back in the bag, and it just doesn't want to go to the vet. Well, that's what is starting to happen in the unemployment market. And this SOM rule, anytime it's been triggered, has never had a false positive. It's never been triggered and then not led to a recession. It's always led to a recession because this is already telling you the damage is done. Now, today you also had factory orders month over month that came in at negative 3.3%. This was the worst factory orders number you have seen in about a year as well. This is, again, kind of adding to that recession thesis for markets at this point. Tom Lee and Fundstrat, right on X, did the outlook for stocks, quote, suddenly become bearish yesterday? Number 4, reasons why this is ultimately a buying opportunity. Did the outlook for stocks suddenly become bearish yesterday? No. This is why this is a buying opportunity. And he's actually referencing rate cuts here. And there's a problem with this because the markets are now pricing in a 80% chance or so of a September rate cut, but not of just one rate cut, of a 50 basis point rate cut. We're talking a double rate cut in September now is the base case for the Fed. And you can see that here via Liz Young Thomas's X account. She is the head of investment strategy at SoFi. She writes, what a difference 2 days makes. Markets now pricing in a 75 to 80% probability of a 50 basis point cut in September, with 4 to 5 cuts now priced in by the end of this year. This is not the markets saying the Fed is just going to cut rates to normalize policy, to take out some of the restriction. This is the market saying the Fed is going to be cutting because of recession problem. Now, any other time the Fed has cut in the past because of recession issues, that's always led to a steeper crash in markets. On average, this is average, okay? You tend to see about a 23% fall in the S&P when the Fed cuts rates, because normally the Fed is cutting rates into a slowing economy, into a weakening economy, into potentially a recessionary economy. And this time, unfortunately, is starting to look no different. Now, the reason why you're seeing this knee-jerk selling in the Russell, in the S&P is, again, recession fears. Clearly, all rate cuts are not created equal. The only positive rate cuts are, again, if the Fed is cutting into a good economy. That's where the Russell would have been benefited by rate cuts. But the Fed's going to be cutting because of recession fears. That's not going to be good for markets. That's not going to be good for the Russell, the S&P, or the NASDAQ. But I will tell you, the markets have been so consensus soft landing for so long. This data today really just slapped everyone in the face. It slapped the majority in the face today because, I mean, nobody was forecasting a recession. And now you have to really start to think long and hard about a potential recession, about how you should position your big money portfolio. That is really just not a position big money has been in for a very long time. If I could put an analogy to this, this is like when you're a kid and, you know, you don't want to get up for school, you're tired, you keep, you know, your mom or dad or whatever keeps coming in the room trying to wake you up. And then they're like, hey, I'm going to wake you up. I'm going to throw some water on you. You're like, well, whatever, okay, just go back to sleep, go back to sleep, go back to sleep. And then they really come in and throw a big bucket of water on you. Cold water at that, with ice cubes in it. It's a big shocker. And next time your parents come in the room and say they're going to throw a big bucket of ice cold water on you, you really start to pay attention. You get up, okay? That's what we're really seeing now in markets. That initial bucket just got thrown on you. And it just shocked Wall Street, and it just woke Wall Street up. And now every data point that we get is going to be very important. And even to some extent, data points that were not important in the past that have started to look bad, like durable goods orders that came in negative almost 7% last month. Wow, okay, that was really bad. Did Wall Street care? No. This time around, Wall Street's going to start to care about the data, because now everyone's, has recession potentially on their radar. Now, of course, there are some firms that are going to try to justify this rise in the unemployment rate, but you can't, unfortunately. Fitch Ratings says, quote, the rise in the unemployment rate does not reflect workers losing their jobs. Payrolls have grown at an average monthly rate of 170,000 over the last 3 months. Rather, it's a reflection of expanding labor supply. The working age population increased and the participation rate rose. That bodes well for further easing in labor market conditions, which will be welcomed by the Fed. This helps turn the key a little further towards unlocking a September rate cut. And at this point, I think Fitch Ratings has lost their mind. You think in just the last couple of months, the pool of labor supply has grown so much to cause the unemployment rate to go from 3.8% to 4.3%? Have you lost your marbles? Okay, sure, potentially that can account for some of this, but maybe 20%. Maybe 10% of this, but that's far from being able to justify these kind of reports that we are seeing. Now, I do want to share this clip with you from CNBC. It's from JP Morgan's Feroli. He says, don't see why the Fed wants to take, quote, baby steps with rate cuts.
Chief U.S. economist Michael Feroli joins us now to discuss, wow, and that escalated quickly. Why are you going so bold with these double predictions for rate cuts?
Look, I think even if we have a, moderation in these job numbers, if they improve, let's say, in the next month's report, still feels like, risks are pretty balanced on both the inflation and employment mandates. So I would say, rates at 5.5% is probably about 100 basis points at least above where you should be if you think you want to be back to neutral to address risks to either inflation and employment. So if you think you need to be at neutral, why drag your feet and getting back to something like 4 to 4.5%.
Because they just want to be sure, right? On the inflation, it's why they've been so hesitant to cut rates until now, especially with the flare-up earlier this year.
Yeah, and I would just add to that, we heard 2 days ago from Chair Powell, and he was abundantly clear that he was going to be sensitive to weakness in the employment numbers. And, we got some hints of that yesterday, and then we got a very big indication of that this morning. So given Powell's message, I don't see why they would, want to just take, little baby steps in getting back on sides.
Well, he was also very clear on Wednesday that they were not thinking about 50 basis points as a cut.
Well, he said they weren't considering it on Wednesday. On Wednesday, they didn't have today's data in hand. So, when the facts change, you got to change what you're thinking.
But put this data in the context of other data releases we've had lately. I know ISM manufacturing was weak, but overall, if you look at GDP, if you look at the job openings picture, there's still more than 8 million of them. I mean, things are cooling, no doubt about it, but not suggesting necessarily that we're heading into a harder landing or recession type environment, which might be the signal if they start doing 50 basis point cuts.
So, you're right that I think, GDP growth in the third quarter we still think is going to be in positive territory. That said, we are, as you point out, losing momentum. So even a 4.3 unemployment rate is not bad in the absolute, but it's up 0.5 of a percentage point over the past 4 months. So I think we also have to keep track of momentum here, and momentum is sliding. I don't think the Fed wants to get further behind the curve than it already is.
Michael, is there any suggestion that the delay, if it is in fact a delay, is about reaching consensus at the committee?
I think there's always some of that. But, I think Powell has shown this is kind of his committee. But I think there's going to be little trouble getting consensus now for action at the next meeting. I think that would have been hard going into the July meeting, even though in hindsight, of course, you think they should have cut then. But I think you need probably more convincing evidence, and I think we got that this morning.
Meantime, we're starting to have conversations this morning about Jackson Hole and the opportunity that it might give Powell to say, at least we can read the room. We are on the case.
Yeah, I think that's right. I think Powell will probably send a pretty strong message there that they're not, asleep at the wheel here, and that the message from 2 days ago that they're going to be sensitive to labor market weakness is something that I think he'll back up vociferously at Jackson Hole.
Would you characterize this morning's print as weak, or is it more about, as some have suggested today, about a wave of nice participation taking shape?
So there definitely was the best part of this report, was the increase in participation. However, you did have a pretty significant increase in job losers, accounting for most of that rise in unemployment. So, and I would also add to that the fact that the work week went down at the same time that wage growth is moderating. So it does look like labor demand overall does appear to be softening. And you had actually less than half of industries participate in the increase in employment last month. So it wasn't a very broad-based gain in job growth either, which can be a bit of a worrying signal about overall labor demand.
Do you think we're going to see a negative payrolls print this year?
Certainly wouldn't rule it out at this point, given the way the momentum is shifting here. And I think you see a little bit of hints of that in things like the continuing claims numbers yesterday. We're not forecasting negative payrolls, but I think at these new lower run rate we've been seeing lately, it's not hard to get there.
Nick Timmerhouse writes on X, Citi and JP Morgan expect the Fed to now cut rates by 50 basis points in September, 50 basis points in November, and 25 in December. So you're really starting to see those rate cut odds ramp up from your largest banks. And we did it. The stock market hits extreme fear for the first time since October of 2023, looking at the Fear and Greed Index. As Zero Hedge writes on X, the Nikkei is looking at a negative 5% open on Monday, will bring the 3-day drop to 13% and spark epic deflationary shock. Idiots at the Bank of Japan blew up the world again. That's because today Japanese stocks suffer the biggest fall since 2020 on economic concerns. The Nikkei average closes down 5.8%, with chip shares especially hit hard. Fundstrat is issuing an intraday alert They say overreaction to July jobs miss. Soft jobs report still supports soft landing and gives Fed room for cuts. The VIX surging 50% to 28 means panic, and short term means sellers will be pressuring markets. The July jobs report was a miss, coming in at 114,000 versus 175,000 expected by the street. And I do think that is correct. I think to some extent, this multiple days of selling is a little extreme. The VIX up 50% today is a little extreme. Let's be honest. Well, now the VIX is up 36.36%, but this is a vertical spike in the VIX, something that you have not seen in a long time. Okay, you have to go back to really, a couple instances in late 2021, a couple instances in 2022, but this is the fastest rally you have seen in the VIX in a very long time. And again, it's that cold water analogy, because the VIX is really just looking at the S&P 500 puts and calls. So as everyone was skewed towards calls and not really in downside protection, you got this cold water thrown on us. This holy crap, recession risk is actually here. And then everyone sold out of calls. They went into puts. So that's why you're seeing this rapid, straight up movement in the VIX. Compared to 2021 and 2022, when it was more balanced, when there were more bears out on Wall Street, when there were more calls, still than puts, but there was a decent amount of puts during that time. We've been in such a low volatility period. Nobody was ready for this today. And again, I'm not going to sugarcoat it for you. Tom Lee and Fundstrat are still under the assumption that 50 basis point rate cuts are good, that's good for markets. That is not good for markets. It has never historically been good for markets. And if this momentum does continue, and if, let's say, JP Morgan and Citi are correct and we get 50 basis points September, 50 basis points in November, and 25 in December, that's not going to be good for markets. Markets are not going to react positively to that. So yes, I do think the selling is extreme in the Russell, that even my forecasts were, conservative, which is kind of insane, right? People thought 5 to 6% downside in 2 days for the Russell would have been crazy. But that's exactly what happened. And it even overshot that a little bit. If you include Wednesday as well, that drop from after the Fed stopped speaking, then you're adding 7+%, 8-9% to the total drop in the Russell this week. I do think there is room for a short-term bounce here. I do think we are going to get a lot of volatility, a lot of big up days, a lot of big down days, but this is the start of something different. Do not be confused here. This is the start of a recession. This is the start of recession being priced into markets. If you sit here and say recession is priced into markets now, you're lying to yourself. That's a fool's error. Don't do that. Recession is not priced into our markets. It is starting to get priced into our markets, but it's not even close to being priced into markets yet. If you still look at where markets are compared to the high of 2021, you're still up 14.5% after the drop we've seen from all-time highs. You have not priced in a recession, and there will be a lot more downside. Now, in the short term, the S&P is bouncing off of this 100-day moving average today at $528 per share. You've seen quite a nice bounce. You're currently trading at almost $533 per share, still down almost 2%, but not nearly as bad as it was at one point today. So this 100-day moving average could serve as some short-term support. It wouldn't surprise me to see markets bounce between the 100-day and the 50-day moving average. The problem will become when you break under that 100-day moving average. Then you're setting yourself up for a much larger decline. Fed Goolsbee says today small business defaults and delinquencies are rising and are in the warning sign stage. Fed Goolsbee also says the economy still has cross currents. He also says when conditions warrant a cut, there tends not to be just one. Fed Goolsbee says it is not a secret that Fed policymakers expect multiple cuts over the next year. He also says we're going to get a lot of information before the next meeting. And Fed Goolsbee finally says what will determine the size of the rate cut, or if there is any action, will be the economic conditions. And then he says we've been saying for a long time we'd never want to overreact to 1 month's data. And this is potentially why the markets are bouncing a little bit today, because of these comments from Goolsbee. But nonetheless, let me know what you think about all of this information down below in the comment section. Hit the like button as well as subscribe to the channel if you have not done so already. You guys have a fantastic rest of your day, and I will see you in the next one.